If you're just looking at this earnings report and thinking, oh, the memory company beat expectations again, then you're only seeing the outcome, not the reason behind it. What really matters is that this quarter sends a clear signal to the market. AI is no longer just pushing memory demand, higher starting to redefine what reasonable pricing and long-term supply-demand balance actually mean from this moment on. The old cyclical benchmarks for valuing the memory industry are becoming fundamentally irrelevant. Hey everyone, this is Deep Dive Stock Earnings. Today, what I want to do isn't just recap the numbers that shift the perspective entirely, because the real question this report answers isn't, how did the quarter go? It's, can we still use the old rules to understand this industry over the next few years? If you miss that point, everything else is numbers. The growth, the margins, you're going to underestimate it all. Let's start with the most basic and often overlooked numbers. Micron Technology's revenue in FYQ1 2026 came in well above consensus by nearly $800 million, but the real story isn't just how much it beat, it's why it can keep beating. This growth wasn't driven by a single customer pulling ahead in one quarter, nor was it a short-term inventory rebound that typically shows up at the bottom of a cycle. It was fueled by AI data center demand, simultaneously ramping across multiple product lines, including high-end DRAM, HBM, and specialized memory for servers and accelerated computing. This is a critical point because it determines whether we can still interpret this report as a cyclical rebound. In past memory recoveries, revenue spikes were almost always driven by single product surges or concentrated customer restocking. This time, AI-related demand is appearing across multiple product tiers, and the timing is highly synchronized. That means the demand isn't being pulled by pricing, it's being forced into existence by the architecture of compute itself. This structural change is even more obvious when you look at profitability. In FYQ1 2026, Micron's gross margin jumped roughly 11 percentage points to 56.8%. That's not only well above the market's expectation for this cycle, it exceeds what we've historically seen in most early recovery phases, and importantly, this margin improvement isn't coming from short-term cost swings. It's happening alongside ASP increases and optimized product mix simultaneously. If you just see 56.8% and think, peak cycle, you're missing a critical context. Historically, memory gross margins drop quickly because supply can ramp up fast. Now, supply isn't just about wafer counts, it's structurally constrained by HBM, advanced nodes, and packaging capabilities. This isn't temporary, it's a fundamental shift locking in profitability. This trend is further amplified in the company's forward guidance. FYQ to revenue is projected at $18.07 billion, roughly $4.05 billion, above the market's original expectations. This isn't a short-term blip. It reflects a real shift in the slope of demand, and on top of that higher revenue base, the company expects gross margins to continue rising, approaching 68%, showing that pricing power and profit elasticity aren't being diluted as scale expands. What's really important here isn't the $18.07 billion or the 68% gross margin itself, as the structural implication behind it. AI demand is growing in leaps, reshaping the memory market, while supply hasn't caught up, giving vendors strong pricing power. In other words, the old cyclical logic is broken. Memory prices no longer fluctuate purely with inventory swings. The key variable behind all this is HBM's central role in AI data centers. As high-performance computing demands accelerate, HBM is no longer a premium, optional upgrade is now the bottleneck that directly determines model training speed and inference performance. Market projections suggest that by 2028, the HBM market could reach $100 billion, even surpassing the total DRAM market. In 2020, for this isn't just a product upgrade, it's an industry reclassification. HBM supply capability has become the core measure of a vendor's competitiveness. When HBM moves from an optional product to a core resource, its industry profile fundamentally changes. Whoever can deliver stable HBM supply can lock in long-term partnerships with cloud providers and large AI data centers over the next several years. Success won't come from chasing orders, it will come from owning the critical supply chain. This also makes pricing power the primary driver of profits, replacing volume growth as the key metric. At the same time, HBM production creates a significant squeeze on traditional DDR5 memory. Industry estimates show that every additional bit of HBM output often costs roughly 3 bits of DDR5 capacity. As process nodes advance and stacking layers increase, this squeeze will intensify, further constraining DRAM supply and systematically lifting the overall price floor for the memory market. This shift in supply structure means we won't see the same peak and fall patterns we've seen historically in memory. The stronger AI demand gets, the higher the HBM proportion, the scarcer standard DRAM becomes, and the higher the overall profit margin floor rises. This not only changes the profit model, but also transforms the industry's risk profile. The real risk is no longer cyclical swings, but whether vendors can keep up with HBM, advanced process nodes, and packaging timelines. Regarding inventory visibility, Micron is providing exceptional transparency. The company has confirmed that its 2026 HBM capacity is essentially fully booked, covering volume, pricing, and delivery schedules for next-generation HBM products. This means that the growth for the next several quarters is almost entirely locked in. It's not a bet on market demand. It's a matter of execution. That also means future growth no longer depends on whether the market will restock or single-quarter swings. It's now fully contingent on production capacity, yields, and execution. As long as plans are executed on schedule, revenue and profit are highly predictably level of visibility that's extremely rare in memory history and gives investors a completely new perspective on long-term profitability. Looking at business structure, this growth isn't driven by a single engine. It's synchronized across multiple segments. Cloud and core data center businesses continue to scale rapidly, while mobile, automotive, and embedded products are also hitting record levels. In some end markets, shipments are down, yet profits are sharply higher, showing that high-end product value and structural optimization outweigh raw volume. This signals a fundamental shift in the industry logic. The profit model is moving from selling more units to selling higher value. Price leverage is systematically replacing volume, becoming the central driver of profitability and valuation for investors. This shift is more important than a single quarter's revenue growth because it represents the long-term health and visibility of the memory industry. On the capex side, the company is maintaining roughly $2 billion in investment, focused on HBM, advanced nodes, and high-end packaging. While it may look like spending on the surface, from an industry perspective, this is essentially the minimum ticket to participate in the AI memory era. Those who can sustain investment and keep pace with technological progress will control pricing power and future profit opportunities. Looking at the big picture, this is not just a routine recovery, it's a structural re-rating that's already underway, from demand to supply, from single products to the entire business line, from price leverage to long-term profitability. Every aspect of this industry is changing at a deep level. If you're still applying old cyclical frameworks to Micron, you're only seeing the start of the trend at the full story. This is Deep Dive Stock Earnings, and we'll continue to dig deeper next time.